this is a very theoretical look at how this stock or any security moves in the market. So what we can see here are two main areas that are kind of flat areas, consolidations, or we would call them trading ranges. It's out of these trading ranges that we're going to have a big movement, either to the upside or to the downside. So Wyckoff wanted to know and figure out how is it in this trading ranges he can recognize what's going to be the next directional bias, whether to the upside or to the downside. He also wanted to figure out, the biggest question for him was, what are the biggest interests doing? And he called those big interests like, the current pension funds or huge hedge funds or huge mutual funds, insurance companies. He called them composite operator. And he said that I want to follow those big money, the footsteps of the big money, and I want in my charts to recognize those footsteps and to follow them as early as possible. And preferably I want to open the position when the trend is established early on and where I can have the advantage of knowing that the directional bias is going to be, in this case, to the upside, and that the big interests have accumulated enough position and they're ready to mark up the stock to the higher level. And this is basically what operators like JP Morgan did in the last century. They were given specific stock, a supply of stock. They would buy even more for their own account, so they would absorb a lot of the supply, create a big bulk of stocks under their ownership, and then because the supply dries up so drastically, then later on they would just mark up the price even with a little bit of demand. So we want to look into the area of consolidations. That's our primary goal. Because once the trend starts, we can open the position in the trend as well on the way up, and we can look at the smaller trading ranges, but still conceptually we want to go to the trading ranges and identify our points of entry as early as we can in the newly established trend.